Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com looks at the markets the past week, including Facebook's faceplant. Robert Campbell, publisher of the Campbell Real Estate Timing Letter, talks to us from San Diego. He says the first major U.S. city to see its real estate bubble burst will be Chicago, which has lost 1 million people due to rising taxes. One of Canada's top real estate agents, Allan Angell, discusses high-end real estate in Greater Vancouver. He says sales have hit rock bottom in West Vancouver and Vancouver's west side. He also believes the government has stolen equity from every price range of real estate, ruining retirement plans for thousands. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. We'll talk to Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye. He's a market historian and the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. Here we are.
Facebook did not have the best of weeks, and neither did Twitter. What happened there?
Well, and I've seen it floating around, I didn't think of it myself, but Facebook did a faceplant. And that was not just the highlight of the year, but that's a spectacular event. Stock had been acting well, strong uptrend, and I never really analyzed it either fundamentally or technically. Nothing was showing up. But they had some announcements and something was changing, and anyways, it was a great disappointment. And the stock gave up 25% in fears. Now, the news came out after when New York, the big market, wasn't open, so you wouldn't have the liquidity, and I don't think anything was staged on it like a raid, but man, the short sure made a lot of money on that one, but it wasn't overly shorted stock, so I think it's a serious break. Then also you had Twitter last night, a similar event, down about 20%. On a major hit, on disappointing something rather. So it's it's concerning, and it takes my memory back in history to in 1873, which was a fabulous bubble, and in New York it peaked in that fateful September, and then was eroding away, and the big high-tech, big market stock then was Western Union Telegraph. It was huge, and it was very high-tech, very widely held, and when it turned bad, all of a sudden, in late September, it gave up about 40% in about 4 trading days. So that was a slaughter. So something like this, and certainly Facebook is a big company. It's serious. So where we stand is that coming out of the first hit of the year, we figure the markets would recover until about May. That's the stock markets, and they would be accompanied by what we call the friends of the bull market, which would have been improving industrial commodity prices, very old-fashioned, that stuff, and improving credit conditions with the curve and spreads. And yes, these worked out, but the highs for commodities that were reached, industrial commodities, lumber was outstanding. and you had a good rally out of some of the base metals. And they have headed south. As a matter of fact, the last 2 trading days for lumber have been down limit, so that's pretty harsh. So our friends of the bull market are no longer friendly, and the hits to these 2 highlight stocks is a serious warning. And on our work, we figured that after August, credit markets would begin to deteriorate. And there's also, Jim, if there is a liquidity problem, it will be discovered in the fall. And the signs of a pending liquidity problem has been tremendous speculation. And you've had speculation in industrial commodities, speculation in the yield curve and in credit spread. You had the fabulous bubble with the Bitcoin thing. And although many people think they're owning investment-grade stocks, speculation has moved them to exceptional high prices. So while the name of the stock may be investment-grade, the price of the stock is speculative. So it's time to be careful.
Bob, how did crude oil and gold do over the past week?
Yeah, gold came down and set a good low a few weeks ago and has recovered a little. Crude oil has been trading back and forth and was down a little bit yesterday. So I don't see much more for crude oil. Seasonality on this one between now and September is not really conclusive, but when you use the seasonality, the part that is conclusive is that you can have a serious low in December, January, and then you've got base metals. Copper can often have a low in November, and then our friend lumber, he can have a low in October. So the outlook going into the fall is not good. But some of the stocks, like the sectors, have done well. The small caps, the RUT, the Russell 2000, made new highs recently, and that's a case of big money pushing small stocks. And then these things like the RUT, the small caps, they can suddenly be discovered without a friend, like Facebook happened here. So you can put us down as being cautiously pessimistic on this one, Jim.
Bob, has the Canadian dollar been a disappointment with the rise in crude not really bringing it up that much?
Yeah, it didn't perform with industrial commodities when they went up. The problem is in Canada, the Liberal government federally is somewhere in the late 1960s, where it's going to be everything for everybody, and it's going to be very expensive, and they don't want to change their minds. And then in the U.S., you have a popular uprising where a number of people have said enough of big government, of being in your face and in your wallet, and we're going to change things and get things back to a responsible and accountable government. It's going to be a bitter struggle, as we've seen, but that is the new world, is to reform intrusive government, and England's trying to get out of Europe with the Brexit. Italy has had a change in government to a reform government. So it's very exciting to watch. As a matter of fact, Jim, I tell my friends that in history of political markets and financial markets, this is perhaps the most exciting time to be vertical and alert to what's going on. I mean, I just love it. The incredible struggles going on in the political market and the incredible struggles going on in the financial market. And fortunately, on the financial side, we've got the tools to be able to trade or advise on it. And so, we haven't had too many surprises. It's just that it fits in with ending action for the old movement of authoritarian government, and the new movement is more freedom. And the old is the huge financial speculation that's been, a bunch of serial bubbles for the last 20 years. It's been absolutely insane. And at some point, the central bankers will no longer be able to rig markets up, and they might be facing some of the opposite.
Bob, thank you so much for being on This Week in Money.
Good to be with you, Jim, and anytime. It was an interesting week in the market.
Coming up on This Week in Money, Robert Campbell, publisher of the Campbell Real Estate Timing Letter.
Always consult your investment professional before making any investment decision.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Robert Campbell, the author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. Bob, welcome back to This Week in Money.
Thank you very much, Jim. Happy to be here again.
Bob, what's the latest on the U.S. real estate market?
U.S. real estate market. U.S. real estate market is still in an uptrend. Prices are still trending higher. And for those of your listeners who don't know what I do, I developed a model for tracking real estate trends. It's based on five key indicators, and it's right about between 80 and 90% of the time, closer to the 90 than the 80. And so that's how I base this stuff. But it's still going up. So you got to be, there's no reason to sell yet. I wouldn't be buying right now, that's for sure. But if you own, there's no reason to sell.
Is there a point where U.S. real estate or U.S. interest rates could hit that would quash the real estate market? Oh,
absolutely. Absolutely. I mean, if rates went up to 7%, that'd probably, be a dark day for the real estate market. However, I mean, that other things would start occurring at the same time that would that have a feedback into real estate. If interest rates went to 7%, with all the debt the U.S. economy owes, hey, that'd be real bad too. So rising interest rates is, I mean, I'm not sure if that would hurt the economy first, as opposed to real estate, but either way, that would have a double-barreled effect on the real estate market. So interest rates, interestingly, are one of my least predictive indicators used in my model. I put them in there because, just so people watch them, because you got to follow them. However, it has the lowest weighting compared to my other indicators.
Are there areas in the U.S. where real estate is topping?
It's popping?
Topping.
Where it's topping? Not yet. I know of no cities yet. And it's my feeling that, I'll tell you, one of the weakest major U.S. cities is Chicago. Chicago lost over 1 million people last year, Jim. I mean, because they are so broke, they're taxing everybody to death. They've cranked property taxes up twice, in the last year or two. People are leaving. And it's kind of like what happened in Detroit. They have such the worst pension problem of any state in the country, and now they're trying to tax everybody to death to make up that shortfall, and people are leaving. So I think Chicago will be the first major U.S. city to go to turn from up to down, and then the other ones will follow after that. But not yet. But it's the weakest city I follow right now of the 25 major cities I follow. Now, and interestingly, the strongest ones are still on the west. Seattle, San Diego, Los Angeles, San Francisco, Portland, on the western side of the United States, Denver's still strong. Las Vegas is still strong. So what's the weaker part is on the eastern side of the United States. New York's kind of weak. New York's been weak. New York's been the most, has underperformed this rally, way more than other U.S. cities. So that's been an underperformer.
Was one of the problems New York real estate was so pricey to start with?
Yeah, well, it's high. I mean, a lot of that stuff, on Central Park, that those, when they put up all those big condos that were selling between $5, $10, and $20 million. Only rich guys could afford to buy those, and they bought those. And I understand, the prices just got ridiculous. You'd have you got your own top of the building with a helicopter port, and you got the whole top floor, and yours forever, and it sells for $50 million. Well, from what I understand, the guys that bought those for $50 million, 2 or 3 or 4 years ago, can't sell them for $50 million right now. That's the word I hear, Jim.
Are banks constricting mortgage credit?
Not yet. Nope, they haven't restricted any yet because the banks won't start tightening lending until the market turns over and they start absorbing losses. People think that the banks see this coming. They don't see it coming. Friggin' banks are the last ones to see it coming. They lend right into a major top. Then it starts turning down, and then they start tightening up. But they're still loose. Low down payments, low FICO scores. I don't see any evidence of tightening. I see more evidence of loosening to some degree.
Is the booming Trump economy likely to affect home prices?
Yes. You know what? And I think, hey, look, housing prices are expensive in the United States. Some places more than others, of course. On the coast, they are. California, yes. A median price home in the city right now, San Francisco, is like $1.7 million. San Jose, Santa Clara, $1.4 million. I mean, those are insane numbers. So at some point, though, that it's just that affordability gets so bad, it reaches a point where it becomes so bad. It's not the sellers that say are going to take profits and start the market down. It's the buyers who back off and say, I'm just not going to do it. And that's what starts the down cycle. From high levels, of course, though. So once the snowball starts running down the hill, it just picks up steam, for a year or 2 or 3 before it, finally hits the bottom. So, but we're not quite there yet. So but that could happen. But the incomes are being stretched for sure. Based on normal income ratios, what people are doing, oh my God, we're close to an inflection point, I think, Jim.
Back in the late 80s, the Japanese snapped up every piece of real estate they could lay their hands on around the planet. What happened then?
Most of that real estate was foreclosed on. The Japanese walked away from it. They lost all of the money that they had invested, and so those were trophy properties too. They were buying up stuff like crazy at the wrong time because everybody thought they were going to be the richest company in the world, the richest country in the world, and control everything. And they lost a lot of money. I mean, I think when they bought stuff, and it just all went back to the bank. The stuff they bought ultimately sold for less than 50% of value. So they got killed. And that's what's so amazing, that, during that period of time. What's interesting is, what I find what's most interesting is that I just turned 71. I've been around real estate my whole life, Jim. I go back at least like 50, 60 years. I know what's happening because most people don't even know these events occurred back then. That, people can lose a lot of money in real estate by buying it, at the wrong time, especially in California. and the Japanese bought a lot of hotels over on the islands, too. The Hawaiian Islands, of course. They lost those. When they were buying into it was in 1990, which is the peak of the U.S. housing cycle before it started down. And that coincided with the peak of the Nikkei Dow and real estate prices before they took a 25-year downturn. So it's kind of interesting when you look back at these cycles, and the conclusions I've come up with are these, Jim. The world's a lot riskier place than most people believe it is.
After the crash, how long did real estate go sideways along the bottom?
Oh, are you talking about California?
Well, the Japanese caused bubble.
Oh, it's still down at the bottom. It fell, the Nikkei Dow hit 39,000 in 1990, 1991. Today, I don't know, I haven't looked at it lately, what is it, 20,000? It's still down 50%, somewhere around there. Residential real estate fell 50%. I think maybe it's appreciated. It's still down 40% from the old peak values, somewhere in that range. Maybe a little more, 40 to 45, depending on the city. Oh, so, I mean, what is that? That's been devastating. People, I mean, if you were counting on that as being your retirement nest egg, your savings, and all of a sudden it falls by 50% and doesn't recover, you're kind of screwed. I mean, but people don't realize that those kind of events, you know, even though they're uncommon, they still can occur. I mean, you can still get into cities like here in the United States where Detroit goes into a downturn, long-term downturn. And my God, you know, that used to be one of the most vibrant and strongest U.S. cities. Then it became one of the weakest. So that's what's interesting is that things can change, that you have no idea are coming. And so what you have to do, as opposed to, you know, but if you have a way of tracking those cycles, which we do, I've created that for my followers, and it's really accurate. My strategy on investing in real estate is buy when you expect price appreciation, and then when prices are likely to go down, get out and invest in some opportunity elsewhere. But these cycles, you go back because you don't know. Nobody knows that when this next big one's going to come. And if you're already rich, let's just say, for example, somebody has $1 million in investment assets, and they lose half of it. Now they aren't comfortable anymore. Most people don't have $1 million, but let's just say you had $250,000. And you're going into retirement with that, and you lose half of it. You're not going to live very long on $125,000, maybe not even $250,000. So my emphasis, especially for most people, especially if you're older 50, is you should pay much more attention to protecting your capital than it is, you know, trying to make a big return on it.
In the past few years, the mainland Chinese have been snapping up real estate around the world. Could they be looking at a repeat of the Japanese experience back in the 80s?
Absolutely. Oh, absolutely. I mean, that could be the same exact experience for these guys. I mean, those guys could get ripped because of their own economy back in China and then get ripped up here in the United States when our housing market turns down. I mean, those guys are very, very vulnerable. I mean, we're all vulnerable here in the United States that it seems to me, the indicators I follow, I'm not, you know, sounding any alarms just yet, but I've been looking at these indicators for so long, I can kind of sense it to some degree, and the indicators are weakening. And we've been in a recovery mode for a long time, both the U.S. economy, the real estate market, everything's at record highs. You know this thing's going to reverse, and in the last 2 decades, since 2020, I mean, the year 2000, I mean, look how much more volatile that the markets have become in the United States. You know, we've had 2 stock market crashes, you know, over 40-45%. We had a real estate crash. You know, California housing prices fell 59% during that. It just seems to me like things are getting way more volatile, and the most likely explanation for that is the Federal Reserve. They've lost control. You know, in order to keep things from collapsing, they got to pump money in system, put interest rates at record lows, and then they create their own bubbles, which is their own problem. And so it appears to me that we're going to have a repeat of that situation. I expect, you know, when this thing corrects, the trend of the stock market is still up. But I think that when this thing corrects, I wouldn't be at all surprised to see another 40-45% drop in the Dow, or you know, something similar to 2008 happened to real estate values here in the United States, because I know how expensive they are. I mean, you know, housing prices are a lot higher driven by, because interest rates are still lower now than they were then, but interest rates are rising. And, you know, it's only a matter of time. I mean, how long can these rates keep rising, where, you know, supporting housing prices that are going up at, you know, 5 to 7% a year nationally, when wages are only going up half as much, Jim? I mean, you know that's gonna that's not a sustainable. And so, and we're pretty stretched right now, right there. So I'm going to start letting my followers know about this, just saying, hey, I just sense something's in the air. I've done this a long time. I mean, and it wouldn't surprise me that if, we're looking at a trend reversal here sometime in the next 6 to 12 months.
We'll have more with Robert Campbell next on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, do you think President Trump would prefer a weaker U.S. dollar?
Absolutely. Because he wants to keep interest rates down. He wants to keep, once you see that as interest rates go up, the dollar gets stronger. It's inflationary. When interest rates go down, the dollar goes down with it. And the Fed is raising rates. That's the fact. We all know that. And why they're doing that, I mean, they know that the U.S. economy is, the average American isn't as well off as he should be, while the higher echelons, the top 10 to 20%, are doing just fine. It's the other 80 to 90 that's still struggling. But they're raising rates, and I think they're raising rates for the simple reason they know they got to go up to cool off this economy, to cool off the market, and try to have a controlled, leveling off period, which is going to happen, and also to protect the pension industry, which is imploding right now by itself because of low interest rates. So we have a lot of things that we're going to be dealing with, and whether it's stocks, real estate, whatever asset class you want, bonds or gold. I think it's really going to be important for the preservation of wealth that people be positioned in those right asset classes, because there's a lot of negative forces happening right now that are more likely to occur than not occur.
Gold and silver remain in a long-term trading range. What do you see ahead for gold and silver?
Well, I love gold and silver. I think everybody should have 1/3 of their investment assets invested in it. Long-term hold, not a market timing thing. But gold is been very, very weak, and because the stock market's so strong, the real estate market's so strong, the bond market's still strong. I don't think there's any interest in gold, but over the gold or silver. But over the course of the next 5 years, the commodities, which includes gold and silver, are going to strongly outperform the U.S. stock market and real estate market. So that's going to be a place to be. But it's in a downtrend right now. You know what's going to make gold and silver take off? It's going to be almost a complete distrust of the government, where people, and that's the kind of direction we're going, where it's so crazy, people goes, you guys are nuts, all of you. We don't want any of this. They don't trust anybody, and then of course that will lead to violence and social unrest and all that. The stock market will trade off, the real estate market will trade off, all that stuff will trade off, and gold and silver will be the recipient, because I think that's the direction we're going, and that's the direction we're going worldwide, Jim. We're going towards social unrest. People are fed up with the existing crowd. I mean, that 28-year-old over and that 28-year-old whatever here in the United States that beat out some incumbent. I mean, she doesn't know anything. But you know what people want? All they want is a new face. That's all they want right now. They want the old guys out and the new guys in, and I think it's coming to a head. I think it's just going to get more and more intense until you're going to see something like, hey, we're not putting up with this anymore. You know, the old ways are out and the new ways are in.
I can't recall her name either, but she displaced in the Democratic primaries a man who'd run and won in 10 different elections. So do you think young people might be the hope? They have new ideas, fresh ideas?
No, she's just one of that shows you how dangerous the place is, because that woman doesn't know anything about anything. I mean, that's meaningful. She just got in there, and just because she's a brand new face, and she's up against the standard, the status quo. And that's how she got elected. She ain't getting elected because she's some economic genius. I mean, she doesn't know anything about that. But that's the wave, Jim. That's the wave that's coming. And that's just more evidence of it. And we're going to see more and more and more evidence. It started with Brexit. Then Trump got elected. I mean, those were two major things. I mean, now you see it in other places over in Europe. They're fighting it like crazy in Europe. Spain wants to break off, and they just send the military in there to keep them in. That's not normal stuff. So people have had it. And the reason people have had it is for one reason: economics. They're not doing as well as they should be doing. And statistics show this. Oh, came across something the other day, and it shows the how the new people coming into the world, the millennials and the Echo kids and the Xers or whatever they are, based on past and the direction they're going, they're expected to make between 20 and 30% less, have a lower standard of living than like people in my generation, the baby boom generation. I mean, and this wasn't subjective. This was just objectively done the way things are based on how much money they have, how much things cost, and what's correct. So, in other words, these kids are upset, and that's probably where it'll start. They're just going to go elect these new people that don't know anything just because they're different from the status quo. And I think that trend's going to continue, and it'll reach a head at some point in time, and that's when all of a sudden people are going to lose trust in the government, because the government will do something real crazy, like bring out the military or something, to keep the peasants, in tow, and then all of a sudden, that's when the economy goes to hell, the currency goes to hell, and that kind of stuff, and you start to see high inflation, and that's when gold and silver will take off. That's where everybody wants their money.
Is the Dow likely to see new highs in the second half of this year?
I have no idea, but the trend is up. Wouldn't surprise me one bit. The trend's up. I mean, I'm a trend follower. The major trend is up. I was watching the news the other day, and I find it much easier to believe what I see in a chart than what the experts, than what the opinions are on financial news. And the trend of the market is still up. The U.S. stock markets are above their 200-day moving averages, and the long-term trend is up. And something on the news the other day said the perfect storm is developing. We have a rising dollar, rising interest rates, trade tariffs, and there was one other thing that was in there, that was really bothering everybody, and people were wrenching their hands. Yeah, and the stock market's up 700 points since then. I mean, so all you can do is go with the trend, and there's no evidence that the trend has changed yet. But so I mean, it's still going up. It would surprise me if it goes to 36,000, to 40,000, 50,000. I mean, what is this? Is this real money, or is this just credit created out of nothing? I mean, you think these numbers reflect the state of the U.S. economy in general? No, not at all. And that's where the social unrest is coming, and that's why Trump still has a sound base. Regardless of the dumb things he said and how abrasive he is and all that kind of stuff, because middle America still loves this guy because they think he's the real deal. He's from old time. He's not like today's politicians, and I think that trend's going to continue.
We'll have more with Robert Campbell next on This Week in Money.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Allan Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Allan's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at allanresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, are there any market sectors you really like?
Market sectors I really like. Well, that changes from time to time because when I invest in the market, I invest more in short-term trends than I do long-term trends. I'm not a buy and hold investor, Jim. So U.S. stocks are still rising. And within what sectors are really doing well? Technology is really doing well. Technology is doing well. And in the last 3 or 4 months, real estate ETFs have been doing really well. So those are two that I kind of follow that are outperforming everything else, at least right now. But that can change in weeks or months, and so that I don't really see anything out there on the horizon right now that shows that a collapse in any asset prices is looming right at this point in time.
What do you see ahead for the bond market?
Higher rates, lower prices.
Are there
ways? It's going to happen. I mean, that's the trend too. It's going to go up, and I think these guys, the U.S. pension industry in the United States is $18 trillion, and in general, they're like 32% underfunded as a whole. And one of the reasons they're underfunded is we dropped interest rates to zero, and they couldn't make a return on their investments, and they have to hold bond investments, many of them, at least 50%. Social Security has to have 100% of their money in U.S. Treasury bonds, those type of investments. So these trust funds, not only have they been, people have they've been too generous giving them out, but they've been underperforming very dramatically, on a return on investment. And so there's this 32% gap that everybody's facing right now in the near future. I mean, it's honest right now in certain cities. That's going to have to be taken care of. Either you cut benefits or you start taxing people like they're doing in Chicago, taxing everybody to death to cover the government pensions that can't be paid. And the people are responding by moving out. So I don't think there's any way out of that problem. There's no way out.
Are there ways to short the U.S. real estate market?
I think if you go to some ETFs, there's some short real estate funds. Just like there's ETFs that you buy, there's ETFs that they're called inverse funds that you win when the market goes down. So I know there are some of those funds. I don't look into them very, very much because there's a liquidity problem with them. And even when real estate tanks, they don't move like the market moves. And I don't know why, but it's never something that has interested in me. And like they did in 2008, like the Big Short, those guys went to the futures market, or somehow they shorted those mortgage-backed securities. How'd they do that? How'd those guys do that in the movie? Do you remember?
I don't recall.
Were they in the futures market? But I mean, they made a fortune doing that. But the average retail small investor, I don't think there's any. The best way to deal with a declining real estate market is to get in cash and wait for the next opportunity, to buy fear, like Warren Buffett would tell you.
Has the definition of inflation changed from the 80s and 90s to today?
The definition hasn't changed. The calculations for computing it has. For example, by today's calculations, the inflation rate's like 2% or something like that. So if you go back to the Bill Clinton days, he changed the formula back in 81 or something like that. changed it to keep inflation low, so he wouldn't have to, adjust the Social Security payments higher with real inflation numbers. He adjusted it to close to where it is today. If you use his old formula, it'd be around 6%. So inflation isn't anywhere close to 2%. I would say it's probably in the 5 to 6% range. And that's definitely true of life's essentials, like housing, rent, food, medical. Friggin' medical's going up at 10% a year. I mean, medical's 20% of everybody's budget these days. Jimmy, there's a big hunk right there. So that's out of control. People's purchasing power on their money is eroding far faster than the government wants you to know. That's another reason they're pissed off, the people. They can sense it. All of a sudden they go, gee, I'm making, $60,000 last year, and this year I'm making $61,000. And it doesn't cover what it used to. It doesn't cover what it used to. So they're going down. They sense that they're going down. And because they are going down with the purchasing power of their money. And that's, long term, that's what leads to, social unrest.
Well, yes, both the Canadian and the U.S. governments some time ago agreed to take fuel and housing prices out of the inflation index, saying they were too volatile.
Of course.
Yeah.
Like what? Because you always have an alternative. You don't have to live in a home or rent an apartment. You can live in your car, right, Jim?
But you have to drive it, and they took fuel prices out of the index.
But there's these hedonic adjustments, right? It's like when the price of beef goes to $20 a pound, you can always buy tender victuals because that you won't starve if you eat that.
And your fur will be so nice and shiny. Can the actions of a state government like California have a significant effect on home prices?
I don't know. I mean, I guess they could. If they came out here and said, look, we're broke like everybody else. We're not that far behind Illinois, which is a fact. We got a pension problem that's the biggest in the country. Okay, we need to fix that. Most people that own real estate in California have some money, right? You have to have some money, okay? We're going to put a $5,000 per year temporary supplemental tax against your property, to get us through these hard times, so we can pay the pensions of the government workers. That would probably have a big effect.
Yes, the BC government has put a special tax on homes worth $3 million and more. They call it a school tax, but the people in those homes bought them a long time ago. They're pensioners. They don't have the cash to pay it and may end up selling their houses. Do you think the government intended that? Or are they just greedy?
They have no choice, Jim. They're broke. Everybody's broke. The government's broke. I mean, look what the U.S. deficit's going to be this year. It's going to be over a trillion again. When will the next economic downturn come? It's not going to be 1.4 trillion. It's going to be 2.4 trillion. Everybody's living on borrowed money, especially the government. The government is in much worse shape than the average American. They learned their lesson during the last one to some degree. They've backed off. They're not borrowing money out of their houses anymore to get plastic surgery or any other life essentials like that. But it's the government. The government is like, right now, if rates were to double, I mean, they've already gone up like 50%. If they go up another 50%, the payment on the national debt is going to double. I mean, we could start reaching the point where it's going to be $700-800 billion, close to $1 trillion a year, just in interest expense. The government's going to get hit the hardest by this, Jim. I mean, of course, they're going to pass it on to you and I, right? Well, you think they're all going to, just shut down spending? They'll start spending more. So that's, this debt just gets the noose just gets a little tighter and a little tighter and a little tighter all the time, and you don't know when it's going to be. Okay, that's it. We're all screwed. Get used to it. You should have never voted us into office. We didn't know what we were doing. But that's the way the world works.
Bob, how can people find out more about your newsletter and your book?
They can go to my website. My website is as follows: realestatetiming.com. Real estate, just like it's spelled, timing, TIMG.com. And if you want to, anybody that wants to come down to San Diego, I'm having a seminar for all my followers on October 2nd of this year, teaching you how to time real estate markets so you'll know more than 99% of all people in the business. And that's experienced people, too. So if you know what to follow, you can do that. Most people don't have the time to do it, but realestatetiming.com, and you can see what I do.
Bob, thanks a lot for chatting with us.
Okay, Jimmy. Nice talking to you, too. I'll see you later. Thanks.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. He was speaking to us from San Diego. Coming up, Allan Mark Angell, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Allan Mark Angell. He's one of the top realtors in Canada. He's sold more than 4,000 properties. He's located in West Vancouver in BC and online at theangelgroup.com, the ANGELL group.com. Allan, welcome back to This Week in Money.
Thank you, Connie. I'm glad to be here.
The last time we spoke, the BC NDP government had just targeted foreign owners of real estate in their 2018 BC budget. Has this had any effect on high-end markets in West Vancouver and the west side of Vancouver?
Before I answer that, Jim, I'd just like to make a comment if I could.
Sure.
So people understand, I've been a realtor since 1972. When I started so bad I couldn't say my name, so I started doing my stats. The reason I did that because I had to show people, I couldn't talk them into it. So by 8 years, I was a top realtor in Canada. It was all based on my stats. So I still do all my stats. It's probably made me one of Canada's most successful realtors because I do the stats, and I still do. They're more important today than they have been. And I haven't shared my stats with other than my clients over the years because I was number one realtor. Now I'm at the stage where everybody needs these stats because the board doesn't put them out, that they mislead you by saying the market's softened and blah, blah, blah. So the stats are the most important thing you could do. It tells you what's going on in the marketplace. So referring to your first question about the NDP, yes, it's been huge. The NDP, our market ended in May of 2016. That's when it ended. The first tax, the buyer's tax, came in at August of 2016, and we've been paying the price since. Most people think the market ended last year. No, it's been bad for 2 years. Prices, it takes months and months before the prices, people realize that they're changing and they've started to adjust. Just to give you a couple of examples here, if you take sales in 2016 in West Vancouver over $6 million for the first 6 months of the year. In 2016, we had 70 over $6 million. The NDPs come in, and now this year, the first 6 months over 6 million, we've had 12 compared to 70. And the odd thing is there's about 120 houses on the market over 6 million in West Vancouver, and we've sold 12 in 6 months. That's 2 a month. You go well over 100. If you take Vancouver West Side, over 6 million, they're at 37 sales this year, and they have 200 houses on the market over 6. In 2016, for the first 6 months, they had 109. So that's 109 compared to 37. So yes, it's having a huge effect on what's going. The government has tried to stop the high-end market, but unfortunately they've stopped all the market. They've stopped. Doesn't matter what price range you're in, you're being affected. I did one of my last sales. I had an offer on it December for 3.3. We didn't take it. Just sold it for 2.7 a month and a half ago. It's probably worth 2.55 today. So every end of the market is being affected.
How did this attack make homes more affordable, or has it?
Well, most people can't. Houses are expensive. When you look at West Vancouver, the west side, I mean, $2.5–3 million. It hasn't really changed. Prices have lowered, but it's just taken the money out of the equity out of your home. Most people can't afford $3–4 million for a home. So really, no, I don't think it's helped the buyers buy at all. You can't save enough with the bank qualifications today. You can't save enough. You have to have like 50–60%. You know, they give you 50% down. You know, most people can't save that much. So I don't think it's helped the market making it more affordable at all. It was simply an NDP ploy that they vote for me and that's it. All these taxes that they've increased, they said, well, we're going to increase the property purchase tax up to 5%. We're going to make so much more millions and millions that we're going to spend it on these things. Well, sales are at an all-time low. They're not going to make as much money this year as last year with increase. Hasn't changed. All it does is create a hardship for every homeowner.
Have there been a lot of innocent victims of the foreign buyer tax, students and so on, or young people who came from another country and decide they want to have a family and a home in Vancouver, and all of a sudden they're considered foreigners and face a 20% tax?
Well, the purpose of it was really to stop the Chinese. The Chinese have been insulted. They've been invited to the country, and then the government does everything to stop them from buying. But you see, it's not so much them. Maybe you can argue that's a good thing, maybe it's a bad thing. But we have a client, for example. She's been here for 37 years. She's an English person. Still has her citizenship in England, but she's been here for 37 years, living we sold her house, and now she decided she wanted to buy, but because the tax is 20%, even though she's paid tax here and everything else for 37 years, she's not buying because of the taxes. People like that who've been affected, that shouldn't be affected, that they should have been, said, no, these people, we're not going to tax them. They've lived here all this time. The new buyers is a different thing, but it's affecting people that have lived here and still have citizenship somewhere else.
Is there a problem as well that the perception says if you're from outside of Canada, you're just not welcome in Vancouver anymore, or the rest of BC?
Well, the world is like that now. The immigration around the world is like that. It's turning in. The only advantage of being older, I say, is that the world's getting worse and worse, and I won't be around to see it. But they're jealous because the Iranians, the Chinese have lots of money. They're bringing it into the country, and now they say they're money laundering. Maybe they were at the casinos, but in our business, we have no record of that. They come in, they buy a house, they give us a check from one of the banks as a deposit. There's no such thing as cash, so I don't know whether they're money laundering. They're coming here to be safe. You live in West Vancouver where you don't have to lock your doors most days. So it's you can argue that it hasn't achieved its goal.
Are properties over $3 million less likely to sell now due to all these additional taxes imposed by the NDP?
Well, they all are. Give you an example. Great, and not just everybody talks about the high-end market, Vancouver West and West Van. If you look at the Greater Vancouver area, so that's Coquitlam, Maple Ridge Inn and all that. We're at, for this year, we're at 4,405 sales. 4,405. The average throughout and my graphs go back to 1980s. The reason I still use that, because what most people don't know, 1989 was the best year in real estate in history. West Vancouver, we had 1,201 sales, still the highest one. Vancouver West, 2,800 plus. Richmond, 2,800 plus. Since like 2000, you look at West Side and Richmond, they're just over 2,000 sales. So they're 700-800 sales behind the 1989. And so that's why I use these guys, because it all applies. But as I said, Greater Vancouver area, 4,400 sales the first 6 months. If you take the average since the 80s, it's 7,700, so we're 3,000 behind. So that's all houses. If you take the worst by month, I know what I do. I go to the 1980s. What's the worst January? What's the worst February? It doesn't matter what year. So if you take the worst January, February since that time, it's at 5,105. So we're 700 sales behind what accumulated the worst year. So that's how bad it actually is. So it's affecting all homeowners, every single one, not just the wealthy areas for sure.
What kind of a hold does that put on our economy when all of a sudden your real estate isn't worth what it used to be?
Well, think how. See, one of the reasons that I come up with these stats, most of my clients they've been in houses for years. Since the 70s, I sold 3 last year. I sold them in the 70s. Now, they were, that market stopped. When you look at the expensive end, you've had over 7, you've had 4 sales, and you got 90 for sale. Good luck. We also got about 75 new houses under construction right now that are spec houses. If they're going to come on the market next 3 to 6 months, there's going to be so many houses on it and no sales. So it's not just us, my barber or hairdresser, what do you want to call him, his business affected, my clothier, the whole province, in my mind, is coming to a standstill because of the housing market. The government has done this.
Do you think there were a lot of people who thought they would sell their home, retire comfortably, and now those plans are totally ruined?
Oh, you've no idea. I'll give you an example. Our ocean front. There's some high-priced condos around, and the guys, they get older, you want to buy a condo. So a lot of these guys bought condos at $6 million and think that they're going to get 10 to 12 for their house. Well, it isn't happening. Those houses that were 10 to 12, for example, the condo market, the oceanfront market, so the oceanfront market from the 1980s is 21 sales a year. 21 a year for waterfronts in West Vancouver. Since the first tax cut came in August 2016, we have sold 8. Last year 7. This year in West Vancouver, we've sold 1. These houses that were 10 are now 6s. So basically, these guys thought they were going to retire with a nice apartment for $6 million and have $4 million in cash. It's not there. It is not there. Or they're going to give money to other kids to buy houses. It's not there. Now people say, oh, well, that's the rich. But it doesn't matter. If your house was worth $2.5 million a year ago, it's worth $1.7 now. It's affecting all the houses, but it's huge. Nobody wants to come out and say it because the board doesn't print articles like says the market's softening, blah, blah, blah. The realtors get the news there and they don't know it. When you look at the elsewhere, you look at West Vancouver, we have had 172 sales this year. There's 9, that's houses and 129 apartments, so that adds up to 300. There's 900 realtors in West Vancouver alone. There's only been 300 sales. I mean, as I said, the market is at an all-time low. We're going to hit records all over. West Van, as I said, 172 sales for first 6 months. The average is 431. If you take the worst individual month over all the years, it's 207. So we are slashing sales. Vancouver West, 405 sales for 6 months. The average is 993. It's insane what is going on out there, but nobody wants to tell the truth because it's a good time. To be honest with you, it's a good time to buy. There's a lot of great buys out there. You just have to have a realtor who knows what's going on, what's happening, and there are great buys. The spread between the lower price houses and the more expensive is smaller now than it's been in years. So if you're trying to move up, the spread might have been $3 million a year and a half ago. Now it's probably 1.5. It's a great time to move up.
Are these additional taxes imposed by the NDP government having a psychological effect on the rest of the real estate market?
Oh, it's absolutely. And the government promises we're going to increase taxes to have all this extra money to spend on welfare and housing, low income housing and all that. It's not going to be there. The sales are so low, it's not going to be there. It was a total sham. And the fact of the matter is, it bothers me because they don't talk to the right people. They talk to the real estate board. Well, the board does a good job. Their administrative people do a good job, but they have no idea what the market's doing out there. They don't even look. The head guys at the board they do their job. That they run the real estate board, but they don't spend time analyzing, see what the sales are. We tell them what's going on. And the government doesn't talk to guys like me. The market had ended in May of 2016. They didn't have to put these taxes in. It was going to correct itself in any case. The taxes have forced it down to the lowest rate of all time.
We'll have more with Allan Mark Angell next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Allan district of northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Allan Mark Angell, one of Canada's top real estate agents. Allan, how do your stats look for the first half of this year compared to other years?
By far the worst of all time. Well, the MLS didn't start until 1980 and 81, but it was all exclusive. We had NRS, Block Brothers, and all the rest. But my graphs go back to 1984, and it's by far going to be the worst month, by far the worst year we've ever had. In West Vancouver, the worst year ever is 454. I'm predicting 270 sales. Vancouver West is at 405. The average is 993. The worst is 732 for the 6 months. But in the year I'm predicting 700 some sales there. And the worst year of any year since the ages of 2024. So there are going to be 300 sales below the worst of all time.
Are high-end homes not selling because they're being listed for sale with 2016 asking prices?
Well, it's not. Yes, they're too high because it doesn't. The realtors don't spend the time. I spend 2 or 3 hours on my stats. I used to list 50 or 60 houses. I now list 10 or something like that. So I have all the time in the world, to take care of my clients. But it's because the realtors don't study the stats enough that they don't realize how it changed. You think of it. There's only been 300 sales for 1,000 realtors. So what can the realtors actually know? When the board puts out a noodle that says the market's softening, and that's all it's saying, they don't know how the stats actually are. So they're not listing at 216 prices. They're not being told the truth. And the other thing about our business is that, you want to get, when you go in, most people call them 3, 4, 5 realtors do trades. So the end result, of course, is that the house is listed at too high a price. The realtor doesn't want to go in and give them too low a price because they won't get the house. So the goal is out there, let's get the house, then we'll work on the price. So it's not because of 216 prices, it's because the owner doesn't know. I can't tell you how many people I talk to every day, and they have no idea what the market's doing. If you're not in the market, you don't know what it is doing. So it's just that they're not paying attention. They don't want to believe what I say. They don't see the stats because the board doesn't print out they say, well, the market changed over last month, up and down over last, but they don't go through the history and show you when you look at the history, this is the worst market we've ever seen. They're not being told the truth because the realtors don't know it, and the owners don't want to hear it, so they want to try at a higher price. But the same old story: you start too high, you follow it down. That's why I'm doing the stats now. Is because I want people. They're turning down offers every day they should take. An offer for $9 million last year, we sold it for in the 6s. So they're turning them down, and they shouldn't be turning them down because they don't think the market is that bad. So they just need to know the actual stats to see what they should do. This is their money, their equity in their home.
How far would sellers of high-end properties have to drop their prices now to find buyers?
Well, we're selling, if you go over 7, we sold 4 in 6 months, and there's 89 for sale. So what I do, I look at every price range. I don't care what price range you're in. I look at every price range and I see, okay, so how many are for sale in that range? How far do you have to go? Like, for example, in Fast Fat, even between $3 and $4 million, which isn't expensive houses, there's 123 on the market. We're selling 5 a month. 5 a month out of 123. So you look at all the listings, 123, and you have to put yourself into the top 5 or 6 prices to get people to do it. If you're in the 4s, it's like 3 houses a month. In the 5s, there's only 2 houses a month. There's 16 houses listed between 5 and 6. There's 2 sales a month. That's what they have to look at. Say, okay, there's 2 sales. If you look at the next 6 months now in your price range, this is how many sales is going to be. And it'll slow down because the markets are always stronger in the first 6 months of the year. Springtime is the best market. July and August are slow, and Christmas is slower. So we have about 60% of the sales the first 6 months and 40 the last. So you have to look at your price and say, there's all the houses for sale. You've got 78 houses for sale in your price range, whatever price range you're in. And this is, I mean, we're selling 3 a month. We have to price it accordingly. So it varies. You have to look and see how many houses would be. Even the 2 and 3s, 2 to 3 million. 154 houses for sale in West Vancouver. 12 sales a month. And it's going to go down from 12 to probably 9 or 10. So you look at the price range you're in and decide how yours compared to the others in your range.
Is the condition of the high-end real estate market starting to put pressure on the rest of the market?
Oh, it's affected, but it's not, the whole market's being affected. It doesn't matter what price you're in. If you're a homeowner, the government has stole the equity out of your home no matter what price range you're in. It doesn't matter. They say, well, we're attacking the high-end, the wealthy people. All my clients are wealthy. Most of them have lived there older. They're 70s. They've lived there forever and ever. They've lived there for 30 or 40 years. They're retired. They're not wealthy people. The equity's in their home. Now it's being stolen from them.
How tough is it to get mortgages for high-end homes?
It's just about impossible. I give two of the deals that I did around 6. They only gave them $2 million mortgages. $2 million. And a 6, but now, think about that. So you have to come up with $4 million in cash to get a $2 million mortgage here. Now, most of them you can get 50%. See, the foreign buyers, they don't pay cash. I never had an Iranian guy or a Chinese guy come in and pay cash. That does not happen. They come here, they're trying to establish credit, so they get a 50% mortgage and 50% down. So, but as I said, it's tougher. The new qualifications, the stress test they go through now, it's so hard to get. That's why they're making it impossible to buy a high-end house.
Are foreclosures increasing on high-end homes?
Well, they're increasing all over the place. But there's going to be a lot more because, unfortunately, even though the market ended in 2016, it took a year and some people have realized that maybe the market's softening because nobody, other than a guy like myself, he had no idea the market had changed. And even the board, I remember in August, the president of the board was on in August, which was a terrible month, August 2017, said the market's great. It was hogwash. The market was already a year old and it was going. So it's going to be a tough time. As long as the NDP are in, we're going to have a tough market. This market will not change until they are gone.
Are the months of inventory increasing?
Yeah, we started, if you give West Van, I mean, your inventory, the highest inventory West Van's ever had was 627, and we're at the end of June, we're 621. If you go to West Side, you've got 840 houses. The average for 6 months is 734. Greater Vancouver, all areas, 6,555. The average is just under 63. So, yes, you started at 4,200 and now up to 6,600. So they're increasing. Apartments, for example, in West Vancouver have gone from 70 to 139.
Any thoughts on how long it could take to have the high-end market hit bottom?
Well, my guess it'll hit. See, the way the market goes over my career, it goes up for a year, it goes down for a year. It doesn't go down for 3 or 4 years. It just goes up and down, and then it stays flat for a few years. So now it's now coming down for sure at a rapid rate. I don't think it should last more than 4 or 5 months more, and then hopefully it'll hit the bottom and flatten out until the NDP are gone. So I think we got another, let's say, 6 months of a tough time, but it'll be flat after that. It's not going to increase. If you're thinking of selling your home, you do it today because you probably got 4 or 5 years to start making some of this cash back that you have just lost.
Mark, at what point do you think, or what percentage of homes in West Vancouver are mortgaged because people could not afford to pay for the home if they chose to?
I would guess 75%, or even, and that's probably low, because I said the foreign buyers, the new ones, always they want a mortgage to establish credit in the country. I mean, the people that live in the same house since the 70s or 80s are probably clear title. But, you make more money by moving around and getting, learning what real estate's about than you do by staying pat.
Interest rates are continuing to rise. Do rising rates impact the high-end home market?
It impacts them all. It doesn't matter. It impacts the whole market. You go back to 1981 when the market crashed and the rates were 17, 18, 20%. And, we never thought we'd see 10% interest rates again. It affects them all. The only difference is because the rates have been so low, there probably won't be as many foreclosures as there were in the past, because most people, the rates are like 3% or something. So that will probably help them stay in their house.
Are sellers reluctant to set their asking prices to reflect today's selling conditions?
They have no choice. They talk to me, I tell them the truth, but they don't hear it from other realtors. Other realtors get the news that said the market's just softening. So nobody wants they want to hear the best. I just did the appraisal. I thought it would probably sell for $5 million. Some other realtor just listed for 7.9. Not a chance on earth that house will sell. Not a chance on earth. You think you're doing those people a favor by putting it on at that price? Not. But the owners want to get as much money as possible. Nobody wants to believe, because you only have a guy like me who wants to tell the truth, because my clients need to know I can't afford them having turned down offers than taking $1 million less 4 or 5 months from now. It's just not fair to the clients.
What do you see ahead for the second half of this year?
It'll get worse. Prices are probably down about 30%. My guess they'll drop another 10 and then stay flat.
Is there hope for the greater Vancouver area, because we have so many people move here every year, anywhere from 23,000 to 50,000 folks?
Well, it doesn't matter. Even the prices dropping 40%, they're still expensive here. Unless you've made money elsewhere in the world and bring it over, you can't buy. We in Canada, we're taxed so high, we can't save $1 million, $2 million to put down to buy a house. You can't do it. I remember years ago, you could get a mortgage at 95%, even 100%. Now with the rates, you can't. So the market, I just don't see, prices always go up. In my first waterfront I sold was $110,000. I did one over here at just under $30 million. We did the one over town, $52 million. So my career, they've gone from $110 to $50 million. That's scary.
Allan, how can people contact you?
Well, my phone number is probably the best. It's an easy number, 778-888-7474, 888-7474, or my email address is allanmarkangell@gmail.com. And Allan is A-L-L-A-N, Mark, M-A-R-K, Angell, A-N-G-E-L-L. So 2 L's in Allan and 2 L's in Angell. allanmarkangell@gmail.com.
Allan, thank you so much for being on This Week in Money.
Thank you, Johnny Jim. Thanks.
My guest has been Allan Mark Angell, one of Canada's top realtors. He's located in West Vancouver, and you can find him online at theangelgroup.com. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Robert Campbell, and Allan Mark Angell. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allan. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. My guest is Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always glad to be on the show, Jim.
Larry, has it been a hot, slow summer on the market so far?
Well, it's actually been a hot,
very slow summer as far as the markets go. It seems like everybody's away on holidays. But, yeah, the markets have been drifting downward since January. And, you know, that's not a good thing, but I think that's going to end shortly. And what we're seeing is a classic case of summer doldrums, one of the worst I've ever seen. So it's something we got to get through. And but there are a lot of excitement. There's a lot of areas of excitement out there, and especially in the field that we're in. I was just reading an article where they're actually about the amount of EV car manufacturers in China. Now, I did a little survey around with people that I know and asked them what they thought it would be, and everybody was under 50. And it's actually 487 EV car manufacturers. That tells you where the future is going in China, and that should give a good indication of where the future is going to go in Europe, and North America, and South America. It's going to be a lot more manufacturing of electric cars. Governments in China are given incentives to actually to pursue that avenue, and it's worked. I mean, can you believe that? 484 EV car manufacturers. If I hadn't read that number, I'd never have believed it. And I follow that market pretty closely. But what's that tell me? That tells me that there's got to be, multiples of that amount that are in the battery manufacturing business, for the lithium-ion battery manufacturing business. And that's a good thing for us. No matter what they say about reuse and other things that they're trying to do to avoid actually recycling the battery, it's going to come to an end. You need those critical materials. And if you look at the lead-acid batteries, where there's 98% of them are recycled, someday you'll see numbers close to that but that'll be a couple decades out. But you'll see numbers like that on the lithium-ion batteries too. So we're happy to be in the position that we're in. Everything is moving well through the pilot stage. We're getting everything together there. The patents, as we said before, are moving well. We've been expanding our base. We're looking at actually getting involved with some battery manufacturers and hopefully some end users. And that's what Jim Hahn, who's a super salesman, will be starting on next month. And we just recently added a chief technical officer, and he's very knowledgeable about what we're doing, and very gung-ho to get out there and help push our product. Now, I know a lot of people think, oh man, you should just be blistering all of the battery manufacturers, because that's where you're going to end up on recycling their batteries. You have to remember, if you're going to stockpile batteries, if you're going to buy them ahead of time and stockpile them, you're handling a very hazardous material, and you're taking on a huge liability. And I would sooner build relationships, and when we're ready to go, start taking down batteries. And that means that we're ready to start processing those batteries. So this is just to give you kind of a glimpse into the way we look at everything. We know from the contacts that have made from us, there is an endless supply of batteries, people wanting us to take them off their hands. And but like I say, what are you going to do with them? You're going to put them in an open field. I can guarantee you're setting yourself up for a huge fire or explosion. And if you put them in a warehouse, it's the same thing. So right now, we're happy to be developing our product, getting our patents, and then taking on the responsibility of taking those batteries, and then we have to find the right location for that, because lithium-ion batteries are hazardous material, and if you're crossing state lines or provincial lines or country lines, there's special permitting to be done to do that. So It's not just loading them on a truck and hauling them from, say, Vancouver to LA. It's just not going to work that way. And because they are hazardous material, and you're handling a dangerous product. The truck dumps over and spills into a waterway, and the batteries break open, and there's fires and everything else. There's all kinds of contamination that can happen. But we want to take on the batteries when we're able to actually recycle them. That's the key, and that's kind of where we've been at since we started this thing. We started working with recycling lithium-ion batteries to see just exactly what we could get, and now we're working with disassembly. There will be announcements coming out on that, and so we're just moving ahead. And as much as I love the summer, I am looking to put that in my rearview mirror and hope for better markets ahead, Jim.
And Larry, if people wonder, will there be enough electricity in China to power all these electric vehicles? They now have surpassed their goal for solar power production, and they've asked people to stop making more solar power plants. It's booming that fast. So obviously they really do believe in their electrical future in a sustainable way.
Well, they certainly have, and they've put their shoulder behind the wheel on that one. Us in North America have been dragging our feet on it, and it's like we have a huge oil industry in Canada and the U.S., and people don't like to see that disappear. But unfortunately, the oil companies will have to start to diversify. And diversification means that they'll have to get into solar, different forms of energy, solar and electric vehicle energy, all of those things that they will have to do to integrate. Oil's never going to go totally away, but companies that will survive will be those that integrate.
Larry, where are you traded, and how can people find out more information about American Manganese?
We're traded on the Toronto Stock Exchange Venture under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can go visit our website at AmericanManganeseInc.com, and there's all the information that you hear in this broadcast will be there. And you can phone the company at 778-574-4444, or you can reach me on my email at LREAUGH@AMYMN.com.
Larry, thanks for the update.
Thanks, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.